Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Lawrence Gillum. Lawrence, we are matching today. We are twins. I think we have to start there, although we didn't match on the football field because our teams are going in different directions. How are you?
I'm doing well. Yes. Let's get the awkwardness out of the way. At the beginning, we are wearing the same pullover shirt here, but I think it's stylish, so it works.
Absolutely. Monday, uh, after Labor Day, probably should not be wearing white, but we're gonna rebel. We're gonna do it. So here are the disclosures. It's September 8th, 2025 as we're recording this. It is a little after lunchtime here on the East Coast. We hope everybody enjoyed the weekend. Certainly, Lawrence, you enjoyed watching your football team, the Bucks, more than I enjoyed watching my football team, the Chiefs. But hey, it's early. A lot of more football left to be played. Here's our agenda. The market recap. I think it's really impressive that stocks held up as well as they did in the face of that weak jobs number on Friday. So we'll talk about that. Of course, Lawrence being our bond guru, we'll talk about the bond market. You titled your section "The Good, the Bad, and the Ugly." I think I got to think the political uncertainty and the sell-off on the long end of the yield curve has to be the ugly, but
That's
I don't know
correct.
for sure. We didn't pre-plan this, so I'll let you go through where the ugly is. And I think the part of the good is that the bond market's done so well this year. In fact, the ag I noticed this morning is up 6% year to date. That is a really solid year to date return for the bond market, and it's only September. Next, I'll talk about the bull market and try to put it into historical context because a lot of people might think, well, we've been doing so well. The market is up 30% since April. Maybe it's time to roll over. And I get that. But if you look at the numbers and compare where we are in this bull market to history, it suggests that we still have legs. So that's what I'll try to make that case here in the next segment, and then we'll end with a preview of the week ahead. And of course, inflation is the big economic data point this week, even though the Fed is probably locked in at a rate cut of 25 basis points. So market recap first. Again, it's resilient in the face of jobs weakness. I think it's fair to say because the S&P 500 was only down about a quarter of a point on Friday. And that ended up being the decline for the week, about 30 basis points. So not down much. We're up 11% for the year. Very, very good year for stocks. Still, on the sector front, communication services led. That was in large part because of Alphabet. When Google was told they don't have to sell the Chrome browser business, they rallied something like 9%. And that's such a big weight in communication services that's why you see there that sector led. On the downside, you had energy down 3%. Really, the talk of energy has been OPEC increases in production or OPEC plus. And I think that's really creating hangover. You also have a little bit of a sell-off in the more cyclical sectors. I think the tariffs have started to weigh a little bit more on some of the companies that we've heard from lately. So you see some weakness from that. And then lastly, the jobs report was so weak, of course, that I think that was really why you saw the weakness in financials. But nonetheless, we're talking about a really small move. In fact, I've laughed when I've heard some Wall Street trading desks talk about buying the dip. I mean, this is not a dip yet. It's really not. I mean, the dollar didn't really move last week, so we had, some decent but not particularly booming returns, I would say, in international markets. The MSCI EFA developed international benchmark up 0.3%. The MSCI Emerging Market Index up 1.4%. So that was pretty strong. Nice gains in Mexico and nice gains in India, helping prop up that index. So again, pretty decent week given the jobs report was so weak on Friday. I'll talk more about that here in a minute. So Lawrence, turning to the bond market, I mentioned it's such a strong year. it was more than just, I mean, we got almost a year worth of returns last week in some years. So talk about the market reaction to the jobs number. Did that surprise you at all?
No, well, yes and no, and we're going to talk about the reaction. That's part of the good in the bond market section, that the rates market did actually perform like it was supposed to do, like it has historically, despite all the outstanding narratives about debt and deficits that we've talked a lot about. But at the end of the day, the rates market tends to follow the economic data, and the economic data was weaker on Friday, as we talked about, unexpectedly so, and that did cause a rally out of the rates market. So we did see a pretty big move lower in yields last week. So the ag up 90 basis points, up 6% year to date. Keep in mind, though, some of that is coupon, some of that is price appreciation. So the 10-year Treasury yield's about 50 basis points lower now than it was to start the year. So that has certainly helped generate that 6% type return. I don't know how much more legs or how much further we can expect rates to fall from current levels, given our concerns about debt deficits, et cetera. But we will take that 6% year to date thus far. So as it relates to other sectors, a good week broadly across markets. The mortgage-backed securities sector up 1%, up 6.5% year to date. The investment grade corporates up about 1% as well. So it's been a pretty broad rally out of the rates market. What was interesting, and we're not showing spreads here, but on Friday, despite the weak jobs report, high yield spreads tightened on Friday. So it's not a reaction that you typically see, but nonetheless, we did see a positive return out of high yield bonds. Munis have come back to life as well. That'll be the last market I talk about before we move on. But I've been an unbiased cheerleader, I will say, for the muni market, given the struggles that it had to start the year, given the ongoing supply demand challenges that we've seen in that market. But it has shown some life recently, up only about 1% year to date. But over the past couple of months, we have seen the muni market post some pretty positive returns, and importantly, valuations for the muni market remain pretty compelling relative to taxable markets. So I still think there's some legs there as well. But all in all, a pretty good week last week. Primarily a pretty good day on Friday because of the job report, but nonetheless a good week, good year to date period for a lot of these fixed income markets.
Love it. You're benefiting from diversification into bonds. You're benefiting from diversification into foreign equities, and even lately starting to benefit from diversifying into small caps. So turning to commodities real quickly, we see the weakness in the crude oil market, again from OPEC plus production increases. So that was down almost 2%. The precious metals market gets a lot of attention when you talk about the Fed. Sure enough, it responded up 4% last week. That's a big move. And certainly anticipation of rate cuts. A part of that, you had a little bit of weakness in the dollar, but really not anything particularly notable. So this continues to be a really good market for precious metals, an area of the commodities complex that we continue to like at LPL Research. All right, so moving on. Here's your S&P 500 chart. So I mentioned that the stock market was really resilient in the face of that weak jobs report. In fact, not only was it soft, we're looking at an average 3-month average job creation around 20,000, but you actually had 1 month revised to negative, June. And historically, you have to have a negative jobs print before you get a recession. It doesn't necessarily mean that every negative jobs print leads to a recession, but certainly it's one of those boxes that people check. So even though the stock market's up today, you're going to see more people talking about recession risk rising because, well, not only are we close to zero, but we actually, on a 3-month moving average, but we actually got a slight negative in June. But the good news here with this chart is that we're still above the 20-day moving average. That is 64.44. The close on Friday was 64.81. We're not really moving much today. And below that, you've got cushion at the 50-day. You've got cushion at the February highs. So a pullback that gets us below 61.44, the February high, would take a lot. We might do it. In fact, we think the odds favor that happening at some point over the next several months, but it's going to take some more news beyond just what we've been hearing lately because you got more stimulus coming in 2026. You got a really good earnings foundation. You got a lot of AI investment. So it's going to take something that moves rates up or something that causes recession fears to rise, which of course would mean rates down. So those are the geopolitics don't look like they're enough right now to drive a meaningful pullback. We'll see. We still think we're going to get one. It could start in September. That's a seasonally weak month, as you all know, I'm sure. Could be a little later. We don't know what's going to cause it, when it's going to come, and how deep it's going to be. But certainly we're biased toward a pullback being overdue. So let's turn back to the bond market here, Lawrence, and talk about your good, bad, and ugly analogy, and then we'll get back to stocks when we talk about the weekly market commentary and the outlook for the bull market. So we're going to start with the curve shift, and certainly you see a little bit of the influence, I think, from the jobs report here.
Yeah, that's right. So the good with regard to the good, bad, and ugly, certainly the rates market performed how you would expect it to, given the weak job data that we saw on Friday. What I'm showing here is the entire Treasury yield curve. As we know, Treasury Department issues a lot of different bonds with a lot of different maturities, a lot of different tenors, which, by the way, was the Wordle word of the day on Sunday. You got that in two guesses, by the way. I don't know if you play Wordle or not, but
Nice job.
yeah, so my kids were impressed. But anyway, we did have a lower yield curve last week, primarily because of what happened on Friday. So we did see the yield curve move lower by about 10, 15 basis points. But what the good part about that is that the long end of the curve participated as well, right? So we did see the 10-year, the 20-year, the 30-year tenors move lower on the back of that weak job report. Despite concerns about debt and deficit spending, we've spent a lot of time talking about how much issuance is expected to come to the market over the next couple of years, and that would likely keep rates elevated. But we also noted that Treasury yields are a combination of growth and inflation expectations. So if the economy started to show signs of softening, then we could get lower rates as well, and that seems to be what happened on Friday. So the good was that the yield curve was lower, bonds participated, they acted like that diversifier, despite all the other narratives out there that would suggest that rates are higher for longer. Now, that said, I still think that there's going to be some issues digesting Treasury securities on a go-forward basis, but it's just another reminder that Treasury yields tend to follow the economic data.
Yeah, if the Supreme Court rules that the IEEPA tariffs are illegal and they have to be rebated, that will delay that tariff revenue. It will probably come back, but it'll be delayed. I would guess that would put some upward pressure on this curve. Is that fair?
That is fair. Yeah. So we've talked. I think I wrote a blog about it a couple weeks ago, but we've talked about it. But the bond market needs tariff revenues to offset Treasury issuance. The Treasury Department or the U.S. government's running these $2 trillion, upwards of $2 trillion a year in deficits. That $2 trillion needs to be made up with something, and that hole is filled with Treasury issuance. So until we can come up with ways to either cut spending or increase revenues, there's going to be those deficits there that means Treasury issuance will need to continue to increase, but that tariff revenue would help offset some of that deficit spending that we're doing.
All right. So next up is the Fed. So is this your bad? I think it has to be. Lawrence, I lost your audio.
I'm sorry. Yeah, I think after 5 years, I know how to turn a mute button back on. But so this is the bad. And the reason why I put this as the bad is that we've seen this story play out before. The bond market tends to price in pretty aggressive rate cuts, only to have those get repriced out over time. So what I'm showing here is the expected Fed funds rate at the end of next year. For a while, the market was kind of comfortable around 3.2% in terms of an expected neutral rate. We've traded underneath that now, so markets expect the Fed funds rate to be about 2.8% by the end of next year, which would be a decent amount of rate cuts, and importantly, potentially a Fed funds rate below the neutral rate. That would suggest that that things are potentially worse than what we think they are. So I don't know if this is going to stay. Is the bad, I guess, that maybe we don't see a 3% or a Fed funds rate below 3% by next year. If the economy reaccelerates and things don't worsen worse than what we think that they're going to do. So, I put this as a bad, but it seems like there's a bit more optimism in the bond market for rate cuts that may not actually come to fruition.
Yeah, we're used to that, right? Over the last couple of years, there's been a number of periods where the market was pricing in way more cuts than we actually got, and the market handled it okay. I mean, I guess we had a little bit of a tantrum to get us up to 5% on the 10-year yield, but generally speaking, maybe the market can hold up okay under that
Yeah, we're
condition.
not back to the same sort of aggressiveness that was back last September when the market had priced in 10 rate cuts before the Fed even cut one time, right? So that's when we got that sell off in the rates market because of just what was priced in. I don't think we'll see something like that this time around. I just don't know that we're going to get a 2.75 to 3% Fed funds rate by the end of next year. I mean, we'll see, what the economic data looks like, but it seems a little aggressive at this point.
Yeah, and again, that stimulus coming in next year with the One Big Beautiful Bill Act is about 0.9% of GDP in 2026. It's going to be really hard to have a recession under those conditions. So, sure, you could have recession fears rise this year, especially if we get some more job numbers near zero. I guess there's going to be the big BLS revision this week. So that could cause some folks to sound the alarm bells maybe a little bit louder. But our view is still that we get some economic growth in the second half and then a reacceleration, not dramatic, but a reacceleration in 2026. And that should prevent us from needing the Fed funds rate to go to, say, 2.5 or lower. I guess last thing on this, Lawrence, are you in the majority that thinks we're going to get 25 bips and not 50?
Yeah, I think so. I think there'll be discussions, and when we look back at the minute meetings or the meeting minutes, 2 weeks after the September meeting, they'll admit that they discussed the 50-minute or 50 basis point cut. But yeah, I think at the end of the day they'll go 25 this time, potentially another one in October. But we do think rate cuts are coming, but it's going to depend on the data, of course.
Data dependency, no doubt. We will continue to hear that. Probably even after Powell's gone, we're going to hear some of that. Maybe less, but they're still going to have to follow the data over there. All right. So next up is the ugly. I think it's fair to say that what's happening in France, Japan, and the UK all a little bit ugly.
As well as Argentina. I didn't put that on here either, but Argentina is going through a similar type kind of political instability, a period in time where markets are nervous about debt and deficit spending and really taking that out on the long end of curves. So I'm showing the 30-year bonds. They're all normalized at 100 to begin the year. But frankly, you can see that whether it's UK, Germany, Japan, France, long end of curves are selling off because of that fiscal uncertainty. And it hasn't happened here, despite the narrative. The bottom line is the U.S. 30-year, and it's kind of flat on the year. But given what's taken place in Germany and Japan and France, we just got the no confidence vote out of France, so it looks like they're headed for a third government in a year. And all these countries have one thing in common, and that's deficits and fiscal spend. So I think it's a real risk that type of shunning of the long bond could come to the U.S. as well. Not, I would argue, not to the same extent that we're seeing out of Japan and France and Germany, but I do think that the vigilantes, if you will, could show up here in the U.S. and not be big buyers of the 30-year U.S. bond. But it's just been a pretty challenging year for a lot of duration owners out there. If you think about Japan, the 30-year bond is up about 1% this year. If you think, in duration terms, it tends to have like a 30-year duration associated with it. So a lot of these investors that own these bonds are down almost 30% this year alone. So it's a very challenging environment for a lot of these institutional investors that own these bonds, because they're seeing some pretty big mark-to-market losses on their balance sheet right now.
Yeah, I guess we got a whiff of how painful long bond losses can be in 2022 in the US, but they're experiencing that kind of pain and more this year in some of these markets. I
Yeah,
guess
and
we're also. Oh, go ahead.
I was gonna say, unfortunately, these are things that aren't quick fixes either, right? So when you're running
Right.
debt to GDP like Japan is over 200%, and you've got budget deficits like France does in the 5-6%, or even in the US. I mean, those aren't things where you can kind of snap your fingers and fix overnight. These are going to be long drawn out issues, and hopefully this doesn't turn into a European debt crisis 2.0, whereas back then it was the peripheral countries, whereas here it's kind of the main growth engines of the Eurozone. So it's not an easy fix, and it's not a pretty picture for those institutional investors that own this paper.
Yeah, so I think for US investors, we want to watch for this sort of leak, from the global bond market sell-off into the US. We also want to pay attention to currency markets, probably especially the yen, right? Because you could get some weakness in the yen that translates, or weakness in the euro potentially, that translates into US dollar strength, which can tighten financial conditions and potentially curb international returns. And then if you get austerity eventually in these markets, that may be good for bond investors, but the equity market won't like that. So we're not getting austerity in Japan. It looks like we're going the opposite way. But we've certainly seen in the UK what can happen if you don't, if you just let the runaway spending continue. Eventually, you got to put on the brakes. So thanks for that, Lawrence. Really interesting stuff. We wish we didn't have to pay so much attention to global 30-year bonds, but I'll speak for myself anyway. But we do. So let's turn back to the equity market, and specifically kind of putting this 30% run since April in perspective. The first way we do that is we look at how stocks historically have done after they recover from corrections. So we define a correction as a 10 to 20% decline. We mark the point where the S&P 500 recovers from those 10 to 20% corrections. So in this case, it was June 27th of this year when we dug ourselves out of that hole from April and May. From that point, we've gained about 5%. My claim is that is following the normal playbook, and that's the title of the weekly market commentary. Stocks are just following the playbook. So let me explain. This scatter plot shows you the amount of the correction on the horizontal axis. So they're all between -10 and -20. And then on the vertical axis, it shows you how stocks do after that correction is recovered. So again, in this case, it would be after June 27th. And what you see is two really interesting things. First of all, only two of these one-year periods were down. This is a 12-month read after the correction is recovered. Only two one-year periods that were down out of 23 corrections since 1950. So you got a very good chance that the stock market goes up even after you recover those corrections. The other thing that I think is interesting is look how many of these dots are above 10%. It's about 70% of the time, you actually get a double-digit return, 10% or more, in the 12 months after these corrections are recovered. So this averages 16%, as you see on this chart. That is a very positive data point. And we think, frankly, we're we're pretty likely to follow this pattern. Maybe not necessarily double digits, but we think it'd be realistic to expect close to that. Now let's look at this from a different perspective. This is a similar exercise, but instead of just looking at corrections, we look at bear markets. Now, this was a bear market earlier this year. If you measure it on an intraday trading basis, the S&P 500 was down 21% on an intraday basis from its high in February. So let's just count this as a bear market and compare it to all of the other post-bear market recovery bull markets. This first chart shows you, there's two. This first one tells you that on average, these bull markets go on for an additional 27 months. So that would mean 27 months from June of this year, on average, we'd continue a bull market into the peak. Now, this is not quite like 1982 or 1991. Maybe it's like 2013. It's reasonable to expect maybe a little bit of a shorter bull market this time, just because we didn't have a really deep sell-off compared to bear markets, right? A lot of bear markets are down 30% or more. So it's pretty shallow bear market, if you call it a bear market. And valuations were pretty high coming in. So it's still reasonable, we think, to expect this bull to run another year, year and a half, maybe 2 years. But we want to just put out that little bit of a hedge because of the nature of the, we'll call it shallow bear market that we experienced earlier this year. All right, so same study, look at the bear markets. After they have recovered to the prior high, what do you do from there? So again, on the last slide, I showed you that we get a 27-month run on average in the bull markets. Here's the returns. On average, you get 51%. Now that is, it's much better to look at the median, which is certainly much lower than that. But point is, look at all of these double-digit returns after these bull markets, after these bear markets are recovered. 30, 15, call it 11, 16, 9, 30, 85, 15, 42. This is for the listeners who aren't watching. 57. There's a lot of double-digit returns on here. So if we call what we just had in April and May a bear market, and it was very, very close, it was 19% close to close, 21% on an intraday basis, then there is an excellent chance that even after what we just saw in terms of the recovery in June, that we have more to go. We're up 5% since then, since June 27th. This would tell you, we probably got some decent runway ahead. So I don't know if we're going to get double-digit returns the next couple of years, but it's a very reasonable expectation based on this history of bull markets coming out of bears. So I'll go ahead and turn to the week ahead after that, but that's just in the week market commentary. So if you want to read more of our thoughts on this bull market, you can find that on LPL.com. I don't want to sound too bullish because we still think we are due for a pullback. It could be a correction, 10%. More likely it's a pullback in the 5 to 7 range, but we think we're due for one of those, and it'll probably come this fall. But that doesn't really tell you anything about how long this bull market's gonna go, because we'll probably recover from the next sell-off and keep going. Again, because we're gonna keep this economy growing. Speaking of the economy, let's turn to the week ahead economic data. So back to you, Lawrence. We've got inflation data this week. We have also got an ECB meeting, I understand. And you're a bond guy, you don't care about Apple. But we also have an Apple, I guess, iPhone event this week that'll get some attention. So what are you watching? What are you expecting?
I will say that there are some Apple bonds out there that trade inside treasuries with a negative spread. So maybe Apple's the new, risk off safe haven asset. But
How about that? Apple, I wouldn't call it a risk-free bond, but it's certainly priced like that one. That's interesting.
Yep. So yeah, this week it's inflation week, as you point out. CPI for August. The expectation is that we are going to see some of that tariff pass through. Some of those consumer prices increase a little bit year over year. Our chief economist thinks that over the next couple of months we're going to have continued increasing inflationary pressures. That seems to be priced in ish. So I don't know how much of a big reaction we'll get out of the bond market if the numbers come in as expected. Certainly the risk that we get inflation numbers that are greater than what's expected, and that would negatively impact the bond market. So outside of inflation, though, I mean, I'll be curious to see what shows up on that those benchmark revisions. Remember last year we had a pretty big revision. The expectation is there's likely going to be another pretty big downward revision. So maybe the job market isn't as robust as people thought it was, coming into the year and earlier in the year. So the other thing I'll be paying attention to this week is we do have some auctions, the 10-year and a 30-year auction this year, or I'm sorry, this week. So given the concerns about debt and deficit spending, we'll see if buyers show up to those auctions. But for the most part, it should be about the inflation data this week.
Well, I would think after the jobs report Friday, and potentially those job revisions, that there'd be pretty good demand for those auctions,
Yeah, that's right. So
right?
if the
Even though
if
yields have come down.
the job market is kind of weaker than what we expected, and there's already a lot, as we talked about, there's already a lot of rate cuts priced into markets, but there can always be more. So if the data does show up weaker than expected, then we could get a bit out of the long end of the curve, which goes back to the good part of the good, bad, and ugly. If that were the case, then it would show that the bond market is providing that diversification benefits just like it has historically.
Very good. So we will leave it there. Thank you, Lawrence, for joining, for previewing the week ahead. I didn't even know there were bond auctions. This is why I'm glad you're on. And we wanted somebody on who was happy about the football over the weekend. So there was that piece of it too.
I have a feeling I'm going to be happy I just jinxed it myself, didn't I? I think I just jinxed the Bucks, but no. Yeah, I'm happy this week anyway.
Go Bucks. Well, you know what? More exciting than the Bucks victory, even for Bucks fans, I think, is my daughter's 16th birthday is today. So I'm going to end on that happy note. So
Happy birthday to her.
happy 16th birthday, Hillary. Love you. Gonna make sure this birthday is special. She's at school, but we already got some special surprises for her. And I think I might have to ask you for a loan, Lawrence, after we spend what we're gonna spend on the 16th birthday presents. We'll see. We'll see. I'm gonna have to stretch a little bit. My credit quality, my bond rating, will definitely be down next week. So everybody, thanks for listening to LPL Market Signals. We appreciate your support. And thanks again, Lawrence, for joining. We will see you next time. Take care, everybody.